Investing in government securities is a reliable way for beginners to enter the world of investing. Government securities, such as treasury bills and notes, provide a low-risk, fixed-income investment that can be used to diversify an individual's portfolio. Understanding the basics of the types of government securities available and how they work is important for any investor before getting started. What is a government security? Government security represents an investment in the debt issued by a government entity. These securities can be in the form of bonds, bills, notes, or other forms of debt. Governments use these securities to finance their operations and fund infrastructure projects. Government securities are considered a safe investment as they are backed by the full faith and credit of the issuing government. Investors often turn to government securities when they want to minimize risk while still achieving a reasonable return on their investments. For example, investors may want to purchase government securities when they are looking for a low-risk investment with a yield higher than their desired risk threshold. In the United States, government securities are often issued by the United States Treasury, Federal Reserve System, state, and local governments. Aged securities, or securities that have been in circulation for a long period of time, have a lower risk-reward ratio and may be discounted. Investors can also buy government securities directly from the government by purchasing treasury bills, notes, bonds, or certain types of municipal bonds. Foreign government securities are also popular investments in the United States. The US dollar is the world's reserve currency, and as such, most major governments have issued bonds denominated in US dollars to raise capital for their country's economic development and needs. U.S. government securities are considered a strong investment because of the safety and reliability that comes from investing in the United States debt, which is backed by its robust economy. One way to diversify risk is to invest in a range of different types of securities on the market, such as stocks and bonds, and other financial products such as commodities or currencies, like US dollars or Canadian dollars. Another way to diversify risk is to spread your investments across different sectors. For instance, if you have an interest in technology stocks, consider opening mutual funds that invest in technology companies along with those that invest in companies outside of the technology sector. A different way to diversify is to invest in a range of asset classes, such as equities and fixed income, or stocks and bonds. Understanding government securities. Government securities are an integral part of any nation's financial system. They are used by governments to raise funds for various public initiatives and projects. It is important for investors to understand the different types of government securities available, their features, and how they work in order to make informed decisions regarding their investments. We will explore some use cases of government securities and provide insight into how they can be used to maximize returns on investments. Government securities are a form of debt issued by governments around the world. The instruments vary based on where they were created, what their purpose is, and the type of debt they represent. Types of government securities. Public debt instruments can be classified into different types of securities. There are two broad categories for this classification. Municipal securities, which include the debt issued by states or provinces, and sovereign, or national, securities, which include debt issued by countries with full monopolies on borrowing money through their respective banking systems. Public bonds are a type of municipal security. They are similar to other types of government securities in that they're borrowed through a public credit system and have fixed interest rates. Other types of instruments include treasury bills, T-bills, U.S. savings bonds, medium-term notes, MTNs, and notes. Issuing government securities. To issue government securities, the government needs to sell state bonds or treasury bills in its own name. A state bond is issued by a state or province and has different characteristics depending on the country of issuance. Treasury bills are short-term debt instruments that mature within 3 years and have a fixed interest rate. They're also sold by the U.S. government in its own name. The process of issuing public debt instruments begins with a government entity issuing securities for the benefit of investors through an auction process, which is similar to an initial public offering, IPO, for equity. The first thing the company does is list on a stock exchange, which allows outside investors to purchase shares of the company and potentially receive dividends or capital gains from these purchases. When issuing debt securities, one of the first things a government entity does is decide how much money it needs from lenders and how long it will take for the debt to be paid off. This can often be within 3 to 5 years for Treasury bills, but typically 20 to 25 years for bonds issued by a country's central bank. The U.S. Federal Reserve is the central bank of the United States, and it's responsible for issuing debt in accordance with what's known as the monetary policy of the government. The Fed also manages market activity by manipulating interest rates, which are kept low to stimulate economic growth. The Fed can do this in a number of ways, such as buying and selling bonds on behalf of different investors or directing banks to lend money on favorable terms to those who need it most. The interest rate that's tied to a bond is known as the coupon rate. In the case of U.S. Treasury bills, the coupon rate is 0%, which means that you'll never have to pay money upfront for your bond. Bonds issued by countries' central banks usually have an interest rate of 3 to 5% and can be converted into cash at any time. Buying government securities. Government securities are a safe and efficient way to invest in the economy. They provide investors with the security of a fixed income, while also allowing them to benefit from interest payments. Buying government securities is a great option for those looking to diversify their portfolio and take advantage of the stability provided by government debt. We will discuss the different types of government securities available, how they can be bought and sold, and what factors should be taken into consideration when purchasing them. Government securities come in a variety of forms, including bonds and bills. Bonds are typically issued by the U.S. government, while bills are issued by states or municipalities. These two types of securities have different levels of risk and return potential depending on the type of instrument that they are issued in, as well as the maturity date, how long until they mature. Bonds may be bought at a yield to maturity, the interest rate offered for investing, whereas bills usually carry a discount or premium to their face value since they never mature into cash. A bond can be thought of as an IOU that is issued by a government and pays interest over time. The issuer will typically ask for a minimum investment and the bondholder is required to pay back the full amount of principal at maturity. In order to invest in bonds, people must have access to the capital markets, outside sources of funding, that allow them to borrow money at an interest rate determined by investors. Bonds are typically issued by governments and corporations, such as General Electric. The government will issue bonds to help finance projects that have a longer term of time until they mature. If a bond matures, the issuing entity must pay back the full amount of principal plus interest that was promised to investors. The value of the bond will increase over time if interest rates rise and decrease over time if interest rates fall. Bonds are considered safer than stocks because they are issued by large companies with more access to capital markets, which allow them to borrow money at an interest rate determined by investors. Investing in government securities can be a great way to diversify a portfolio, but it's not always simple. Buying government securities often comes with its own set of unique challenges which can make the process seem a bit difficult. Understanding the risks and rewards associated with this type of investment, as well as the regulations that govern it, is essential for anyone looking to add government bonds to their portfolio. The most important thing you need to know about investing in government securities is that they are not risk-free. The yield they offer has been known to fluctuate, so there's always the possibility of losing money. That said, it's important to remember that government bonds generally have a much lower risk than other types of investments like stocks. They are also typically very liquid and can be bought or sold easily without incurring a lot of transaction costs. Ultimately, investing in government securities is about balancing the risks with the potential rewards. If you're looking for a steady investment with guaranteed returns, government bonds may be a safe choice. The bottom line is, government bonds are very popular in the investing world, and they generally provide investors with relatively low risk while also offering steady returns. It's important to remember that there is no risk-free investment, but if you're looking for a low-cost way to secure your future, government securities may be right for you. Thank you for watching.